Hey everyone, this is Kirk here again at OptionAlpha.com. Today we have a very active day for trading, so I want you guys to bear with me through this video. It's going to be a little bit longer than usual, but you can already see on the screen we had a lot of opening trades, and then down below we also had a lot of closing trades to go through as well. But as always with these video updates for just our members here, we're going to go over each one of these, go through them individually so you guys understand exactly what we did on each trade. So without wasting too much time, it was just really a good day to start adding a lot of positions. And now that we're getting close to December expiration, you can see we started to close out some of our December trades that we had and take some profits on some and a little loss on the others. So let's go through some of the closing alerts that we had out today here first. The first one that we did was we had sold back the vertical put spread that we bought for the Qs. So you can see here we bought the Q, the 83.82 put spread. We originally bought it for around $49 and we sold it back today for a $5 credit. Really, this one's pretty simple to go through, and I'll jump back and forth between here and the charts, but our strikes were at 83.82, and with 4 days to go, you can see that the expiration for December coming up real close. We're nowhere near our strikes, so we bought it back for a little bit of a credit just to get this trade off the table since it's already in the money. We don't want to get hit here with an exercise or anything like that, getting close to expiration. So again, just close out the trade. It's a loser, but it is what it is, and we took it off the table for sure. The next one that we closed out was our vertical call spread that we had on JCPenney. And this one we actually had a nice little profit. We sold it for around 26 cents or so, which is a little bit less than our 30-cent premium we usually like to get for a 1-point wide call spread. But we originally sold the 9-10 call spread, and we bought it back here today for a 10-cent debit. Now, ideally, we'd like this thing to come all the way down to zero or expire worthless, but when I go to the chart of JCPenney, you can see that we're right on that doorstep of the $9 short strike down here. So even though it was in the money for most of November, what we did is, again, allowed this thing to work itself out, market cyclicality. The market came all the way back down and now is hovering below this 9 barrier. But again, with 4 days to go, we have a nice profit on the table, so I don't want to take too much risk and have this thing go straight into the money in the next couple days, which it could obviously do. So I'm going to take some money off the table, lock in a nice little profit. It was a good trade. All right, so let's move on. Facebook, we had originally bought a January. So this is actually the only January trade that we closed out, but I'll tell you guys why. But we had originally bought this for $1.50, this call spread that we had bought in Facebook. So again, we didn't sell any premium here. We actually bought the call spread, the 46.49. You can see it's a $3 wide strike call spread. That means that we bought it for $150. Our total profit potential that we could make is $150 of potential profit. But you can see today we sold it back for $250 and we made $100 of the $150 that we can make on this trade. And even though Facebook has been on a tear, it's been running really crazy to the upside, and we have January options, at this point we've made a vast majority of the potential profit that we can make on this trade. So again, like I talk about so much in a lot of the video tutorials and a lot of the free e-course that we have on the blog, that you have to take these trades when you can get them. When you've made the vast majority, 50, 60, 75% of your potential profit, take the trade off the table and don't let the market reverse back around. Just like what happened with JCPenney, Facebook could easily come right back around, and this nice $100 profit per spread can easily turn into a loss or no credit at all. So that's exactly what we did. Again, take a look at the chart of Facebook here. Facebook obviously has been on a tear for the last month and a half here. So really, again, we're taking advantage of what we already have in the market. This is a really great move, and obviously we had a good direction. It was just great luck in picking the right direction here. So let's not jinx ourselves here and potentially try to eke out that last $50 and the market turns on us. All right, so the last one that we took off today was the back ratio in UAL, and that was the December 38.39 call that we closed out for a 9-cent debit. We originally had sold this for a 49, a little bit over that, and so we closed that out for a nice $39 profit. So what we did is just bought back this back ratio, which is just short one and long the other two on UAL. Now, ideally, we'd like UAL to go actually a little bit higher than where it is between now and expiration. We'd actually like it to get a little bit up here into the 39s, but since it's been moving so much higher, what we did is take advantage of what little profit we had in here. We could have had a little bit bigger profit. It was kind of pinned around 38. But since it's moving kind of out of that range, again, with 4 days to go, there's not really much you can do on this. Take a little profit off the table and keep moving forward. All right, so that's all the closing trades that we had or any adjustments that we had. Let's go over all the opening trades. Again, we had so many different alerts this week, so I want to go over them specifically. The first one is BX. We had sold a vertical spread in BX, the 30-31 call spread for 34-cent credit. This is actually really rich premium, and BlackRock, which is BX, has had really high implied volatility, so we were a little bit more aggressive in this one. And again, it doesn't matter, you're on the call side, the put side. You can see we kind of mixed it up throughout the day, call put all over the place, just to keep the portfolio a little bit delta neutral. But in this case, BX had been trading a little bit higher, so we sold the 31-30 call or 30-31 call spread. So again, we'll go to that chart. You can see Blackstone had been trading a little bit higher here, so we sold the 30-31 above the market, just thinking that at some point we could get some market cyclicality here and the stock could start to trade lower over the next month or so. You'll notice that earnings are a little bit further out here, so we should be safe for January expiration with no earnings coming up for Blackstone. The next one that we did was we sold the vertical put spread in P, which is Pandora, and we sold the 24-23 put spread. So again, just $1 wide. So again, a little bit less credit than we usually like to take on a $1 wide credit spread. Again, we usually like to get in there with 30 cents of credit, but in this case, we got in with a 25-cent credit. Not too bad. Pandora has been really, really low recently, and so again, same thing here. We just want to take advantage of some market cyclicality. This also evens out the portfolio as far as deltas, but you can see Pandora has been trading much lower. Implied volatility is back up above that 50th percentile, so we trade a nice little spread below the market, give ourselves room to make some money here. Next one that we did was a vertical call spread on EWZ, and we sold the 46-47 calls. Again, $27 in credit, a couple pennies less than what we usually like to get, but we'll take it right now because the market's giving us a lot of great opportunities to trade. Same thing, EWZ, that we kind of saw with Blackstone, is that the market's moving lower here on this one. So what we're doing is just taking advantage of it, possibly continuing to move lower as stocks move higher. This is the Brazil index, so stocks move higher. We think that this might continue to move lower. And so in that case, we're selling the call spread above the market. You can see we gave ourselves a lot of room on this trade to be right for sure. I'm going to skip the butterfly because I'll go over that one here in a second. That one's a little bit different to explain with this buying it here for a credit. So I'm going to go over this one last, but let's skip down to the Dow Jones, these three down here below. These were all trades that we made today on current existing trades. So we already had a position in Dow, we already had a position in UNG, and we already had a position in Microsoft. And what we did in this case is either married this up and created a big iron condor, or in the case of UNG, we kind of doubled down on our position because we are so strong in our belief that what we think is really great implied volatility is going to turn around on us. So the first one here is we sold a vertical put spread on Dow. We actually have a call spread on DOW right now. So again, we went back in there, sold the 39.38, considering implied volatilities continue to be really high. Took in a 21-cent credit. Now, this is a little bit different because we already have a position in the DOW. We actually didn't need to take in that magic 30-cent credit that we usually look for in a 1-point wide spread. And that's because it really didn't cost us any money in additional margin. We already had a position above the market. Now we have a position below the market. As long as our strikes are the same width apart, so the same dollar width above and below the market, it's not going to cost us any additional margin because the stock can't close at both above and below our positions. It has to close one or the other. So the broker is only going to protect one or the other. It's not going to have to protect both sides of the trade. So this is really pure profit that we're taking in here as long as DOW closes between our strikes. Okay. So moving on down to the UNG, we actually sold a vertical call spread. We actually had a call spread originally that's starting to trade into the money. But again, implied volatility on UNG has been really high, so we sold this other call spread, the 21.22 for 30 cents, took in that great call spread premium. We'll just take a look at the chart of UNG, and you'll see why we're kind of doubling down on this position, and that's because UNG continues to trade higher. For the last month and a half, it's made a huge move. It's almost up almost 16-17%, so we think at some point it's going to start to trade lower between now and January expiration, so we're leaving ourselves lots of time to be right on this trade. I think that at some point it's going to get back down to around this 19.75 level, right around $20. So that's my target for this one. If we can eke out a nice little profit on this, that'd be great. All right, and then the last one that we traded here was a vertical call put spread on Microsoft. So again, we had the call spread and we married it up here with the put spread, the 34.32. A little bit wider here. It was 2 points wide, and so we took in a very small credit. But again, any credit right now is a really great credit. Again, same thing with Dow as in Microsoft. Since we already had a position above the market with the call spreads, adding this put spread didn't cost us any extra money. So it was basically free for the brokerage, for our margin purposes in the brokerage. Again, you can see Microsoft has had a really, really huge move in implied volatility. It's up around the 99th percentile up here. So that means that implied volatility right now in Microsoft is higher than it typically is at any time during the year. So our call spreads are already doing good. The market's moved down, right? So now what we did is we sold this put spread down below the market, 34.32. These are our 2 strike points. So again, we gave ourselves lots of room for Microsoft to continue lower and still make money on this trade. The whole idea here with adding these positions to existing positions is that we didn't add any additional risk or margin. All we did was add credit, and that really improves our probability of success. So hopefully that really helps with today's trading alerts. Again, I know there's a lot of them, so go through them here together. Oh, I forgot one. I'm sorry. I forgot the butterfly on open table. So let's go over this one here together. The butterfly is a little bit tricky. This is a broken wing butterfly. So it actually was an order to buy. That was the original order. But you see that we actually bought it for a negative premium of 40 cents. So what happens is that we actually get a credit even though we are buying the security in the eyes of the broker. Now, this open, a lot of people had questions on. Open is the actual ticker symbol for open table. And it wasn't that we were buying and then opening, and people were a little confused, and I understand that. But that's the ticker symbol open for open table. And so you can see what we did here with this put spread is that we bought the 77.5s, we sold 2 of the 75s, and then we skipped over the 72.5, which is the next logical step of a regular butterfly, and moved all the way down to the 70 puts. So that makes that broken wing. This is that broken wing portion right here, that 75 skipping over the 72.5 to the 70, and that allows us to take in a little bit more premium and make this trade actually a credit. So really what we want is we want broken table to trade kind of anywhere between 72.5, 75 or higher between now and expiration. And as long as it does that, we make a nice little credit. Okay, so that's really the goal of this broken wing butterfly. We'll go to the actual chart. You see why we made the trade and where our strikes are. Huge runoff in open table. Implied volatility was up around the 50th percentile today. It came back down, which is good after we made the trade. But you can see that right here around 75 is kind of where we're pinning our strikes. So as long as open table stays above this level or goes higher between now and expiration, which leaves a lot of room for this market to bounce, then we make a nice little premium on the trade. Okay, so that's what happens with the broken wing butterfly. I'm sorry I didn't go over that earlier. It just takes a little bit more explanation to go over that one as well. Okay, so again, for real this time, I hope you guys like these video trading alerts. There's a lot to go over here, so go back, re-go through the video, check out anything that you missed, add questions to the comment section below. I'll make sure to get to every one of them tonight, as long as it takes me. Happy trading.